Oh, the question always comes up with, why'd you pick that fair value gap? Now, some of you are thinking, yeah, that's the question I've been wanting. You never answer me. When I'm picking specific fair value gaps, or if I'm picking order blocks, or if I'm looking for any specific PD array, it's not simply because it's a down closed candle makes it an order block. It's not simply because there's a separation by one candle defining an exposed single delivery or fair value gap that makes it a tradable fair value gap for me. And this is not going to be encompassing the entire aspects or the complete treatment to a fair value gap, but it's certainly going to divide the waters because there's a lot of people out there that are teaching fair value gap and they don't know what they're talking about. And I want you to take notes here because you're hurting your students when you don't know this. And you're also messing up the consistency that my concepts have because when people watch your shit and you're not crediting me, you're not taking the attention back to my channel where they can further learn. I don't mind that you're demonstrating it in your own YouTube channel. I don't care that you're doing that. Go do that. It's wonderful. I love watching my students do that. But when someone steps out and they pretend they're going to be the mentor with them, you need to sit down. And I mean that. Like, you don't know what the fuck you're doing. And you're literally scamming people and defrauding them if you're getting paid to do it. Because I'm telling everybody, there ain't one person out there teaching my concepts that's doing it right. End of story. That's it. That's it. You're looking for fair value gaps that match this. Okay. If you're looking at a mentor, pseudo mentor, okay, a faux professional, okay, the fake professionals out there, if they're defining anything outside of this, right away, you already know that they don't know what they're talking about. And go watch their old videos and you'll see them doing it wrong based on this information. Okay. And that's why their shit didn't work then. When you have a dealing range, and we define that from this high here, and it's dropping down back to a PD array over here. This was a stop run. So we nixed this. We don't even pay attention to this candlestick. All that was a little bump to take that high, and then price went lower. Let me take that off. I wasn't supposed to do that yet. It drops back down to a discount. I'm looking at this high here and the bodies because this wick is just like this one. It's doing damage. I'm going to go back to the bodies here. And I showed you by drawing that out in time, that's the return to it here. And then we have a shift of market structure. You can define it with this high here. And there's nothing wrong with that in this case because we are expecting what? A large range day to deliver today on Friday because Thursday was an inside day. Using this one, it qualifies it even further because when it trades above this one, it's one candle and then the next candle trades above that high. So it shifts market structure bullish. So any retracement back down into this inefficiency here should be viewed as what? A discount array. Now, because this high is the highest high in this retracement, in a market that's bullish, we can grade that price swing. This is not quarters theory. It's not quarterly theory. It's none of that stuff, okay? This is grading a price swing. I do this with actual dealing ranges, as you see here, and I also do this in price runs where I either expect to enter or when I actually enter the trade, and then where my target is. I know by doing what I'm about to show you here, and you've seen me do this before, but if it's the first time, I'm kind of give you a preamble of why it's important, what's its usefulness to it. I can predict where my future PD arrays are going to form. Now, this is something that I can transfer to you, but I already know where fair value gaps are going to form before the dealing range even forms. And I know that's hard to believe, but that's the superpower ICT has. So, and I know that's going to cause a lot of static, and people are going to put sound bites about it. This is where he said, yep. And you're going to talk about me, and people are going to come to the channel, and they're going to learn. That's how it works. So here's your dealing range, okay? And equilibrium is the halfway point right here. So ideally, your best entries, lowest risk, highest yield in terms of R multiples, is going to be entered on a long at or below this line. Pyramiding has to be limited to this price level here or lower. Now, is that ambiguous? Is there a lot of moving parts to that? Nope, it's very simple, straightforward. Now, how can we use this information to pick the right fair value gaps? How can we use this information to pick the right order blocks? Oh man, you're gonna have to come back on Monday for me to get to that. I'm just kidding. You were pissed off for a second. Oh no! I love my job. Here we have the upper and lower quadrants. Okay, and this is when you want to take a picture. You can see that these are my quadrant levels. Optimal trade entry level here. This, when I need to pull up the OTE, I just change the 0.75 to 0.725 or 0.79 because I round it. I don't do the 78% or I do 79%. And then the rest are, these are over here. These are extensions that they're not going to be taught to you until they're in the book format. It's using the opening range, gap, and standard deviations. So it kind of picks the high and low of the day. And I know that's a little cliffhanger for you too, but what we're seeing here is the quadrants that is grading this dealing range from the high down to that low. Now think about it. Yesterday, I took your attention and told you to start focusing on the relative equal highs where everything was left smooth in the marketplace. That's our bias, it's bullish. So that means we're going to be looking for draws on liquidity for buy side. We're not interested in shorts. So that means you're going to look for bullish order blocks. It means you're going to look for bullish breakers. It means you're going to look for bullish fair value gaps, or you're going to look for fair value gaps that were initially characterized as what would be short selling or premium that's going to be broken and then treated as an inversion fair value gap. You see how everything changes to, these are usable PD arrays. These are reference points that now you can suddenly build an idea or an expectation around versus every down closed candle should be an order block. It's not. It's not. So at 8:30, the algorithm kicks in whether there's news or not, but we had medium impact news driver this morning. So at 8:30, the market trades into our discount array, and then we wait for what? Displacement. We don't just go down here and start buying just because it's trading there. Let the algorithm tip its hand to you. Let the market say, listen, I'm going to show you what I'm about to do. Pay attention. So the market goes above the short-term high here. What makes this candlestick important? It's lower high here and it's lower high here. So that's a swing high. So when the market breaks above that, that's a shift in market structure. So we can see it as such. So that's a shift in market structure. Go back and look at model 2022 mentorship videos and you'll see it's very similar to that. And then it displaces higher. And then we have another swing high. This candlestick's high is lower than that one. And then the lower high on this one. So there's a swing high there. It broke both of them. Leaving what? This buy side imbalance, sell side inefficiency. A portion of the order block or a portion of the fair value gap must, listen folks, listen, okay? It must be at or below the quadrant level. Here's your lower quadrant level. Here's your fair value gap. Is this fair value gap at or below the lower quadrant? Yes. That means that this fair value gap is a proper candidate to be long when you're bullish. When time, 8:30, spooling at 8:30, that's the only 30-minute delineator for a macro. Everything else is 3:15 to 3:45 for the last hour trading, and then you have the first 10 minutes to the top of the hour and the first 10 minutes after the top of the hour. That's every hour macro. Okay, so there's your little skinny on the macros. But 8:30, whether there's news or not, the algorithm will start spooling. If it doesn't start spooling and running, then you just simply wait because it's telling you that it's waiting for the 9:30 opening bell. So what happens if you're anticipating something here and just meanders around or goes lower? Do nothing. Sit still and wait for the 9:30 opening bell. But because I built the case around everything I'm talking about today, see, we're already inside of the equivalent of 2 chapters in a book just with this live stream. Just this live stream talking about the impacts of knowing how to use the economic calendar, knowing how to use the day of week phenomenon, understanding the pools of liquidity and the PD array matrix, and how to now use that information and define which order block, which fair value gaps are the one I trade off of, because that's the one the algorithm is going to use. That's authorship. That's fingerprints, okay? By defining this with the quadrant level here, your fair value gap or order block, which is this down closed candle right there, is that below that quadrant level? Yes. Yes. Is this fair value gap at or less than this quadrant level of this dealing range? Yes. Now watch what happens. The market trades down. We have a little bit of a mohawk. That's fine because you have an order block there. That order block right here. Why am I using that one? Why am I specifically using that one? Because it has the lowest down close in with a body. So the body's projection lower, it's lower, and we don't use this wick. This is your order block right there. So half of that order block is a mean threshold reference point. It's not consequent encroachment. Consequent encroachment is gaps or inefficiencies or wicks. Okay. When it's a candlestick body, in this case it's a bullish order block, half of that range is mean threshold. That price is 452.75. What's the low of that candlestick? The fucking low of 452.75. Folks, that's perfection. Elliott Wave wishes he fucking knew this. Sam Seiden has no idea how to fucking do that. No idea. Well, maybe he does now. He's watching my videos and stuff. But there is no other school of thought that teaches that. None. Wyckoff has no fucking idea. No idea. He's rolling around in his grave right now, wishing he had a fucking pen and pad right now. I wish I would have put that in my writings then. He didn't know about it. Okay? And everybody that uses Wyckoff, they don't have this information in there. Sorry. But that's perfect to the tick. But that's supposed to be buying and selling pressure, right? Buying and selling pressure on the next candlestick right there. What's the candlestick low there? 20,452.75. Not one deviation off by one tick less or above. That value perfectly delivered. And you're going to tell me, you're going to argue with me that it's buying and selling pressure, the randomness of everybody coming together and buying and selling on their bullshit that's going to cause the market to stop right there, right? You know, it takes more faith to believe that than it's simply that there's an autonomous price engine that literally is controlling the fluctuations in the ebb and flow until it's manually disturbed by intervention. That's what's going on. And you can argue with me all you want, but you're never going to convince the author. You're never going to convince me, and you're never going to convince my students have now seen it, they use it, they make money with it. They can predict it, they can anticipate, they can see it. And some of them have communities where they're doing it in the witness of others continuously. And you're never going to convince them that they didn't witness it. Not just once, not once in a blue moon, every fucking day. Now find that in anything else out there. It's not. So the market does what? It rallies back up, and look what it does. It delivers into this volume imbalance. See that? So this volume imbalance, it delivers it. What's it missing? Buy side and sell side delivery. So it lays a body up in there. So it buries a body inside that volume imbalance and then drops right back down into what? That swing high here. Rallies back up, leaves the lower quadrant, trades up to equilibrium. Meanders around in here and then causes what? Another displacement. What is this candlestick right there? What is that? It's a fair value gap. Well, ICT, why didn't you use this one? See, he doesn't even use his own logic. He doesn't even use his own stuff. He's making it up as he goes along. Why didn't he use that fair value gap, ICT? Why aren't you using that? Because isn't that a fair value gap? Isn't that a buy side and sell side efficiency? Ain't that the thing? Ain't that the thing? No. Because where's that? The majority of the body of that buy side and sell side efficiency is what? Above that quadrant. Uh-oh. Starting to make sense now, isn't it? So here we have what? Equilibrium. We're at that we're at that precipice where if you're building a position in all this down here, pyramiding, like you've seen me do many, many times, we're at that halfway point of that dealing range. So that means you have to do all of your business at that price range here or less if you're going to be pyramiding. Otherwise, if you start adding up in here or above it, you're really just tossing good money after potentially you might see a retracement. Even though it's low resistance liquidity runs, meaning that we're not getting a whole lot of deep retracements. What's a characteristic of low resistance liquidity runs? Do you remember? Do you remember what it is? Down close candles will support price higher, and inefficiencies will leave a portion open. Is that hard to remember? I've already said it before, but you probably forgot. But now this is the time when you write it down in your journal. Every day when you first start your day, have that written down in front of you on your notepad. High resistance liquidity runs are going to see a lot of give and take back and forth, and every fair value gap will be closed in. Remember, if it's spending a lot of time in the inefficiencies, what is it doing? It's telling you what? We're inside of high resistance. That means it's going to be problematic for you. You're not going to be comfortable in it. It's going to be back and forth price action. Don't run your stop loss up real quick to break even. Just let it move or don't trade. That's the characteristics with it. So in here, we are in close proximity to equilibrium from the dealing range high, dealing range low. We've already accumulated down here, rallied up, equilibrium, retracement, and then displacement here. So we are seeing this fair value gap dead in the middle, consequent encroachment. We can now take that also. So because it's laying inside of equilibrium and half of that gap is basically overlapping that blue line, which is equilibrium of the dealing range, when you're bullish, how could you use that? Now you can try to put a limit order to buy right at the midpoint, trusting that it's going to leave a lower portion open. Notice how it left this down here open? What is that? It's a breakaway gap. This is a tradable fair value gap. But because the consequent encroachment of this gap, which is this, watch. That's this line right here, okay? It's overlapping with the equilibrium price point or middle of the high to that low. So it's a convergence of two factors of equilibrium or midpoint. So this is where a institutional order flow entry drill would be optimal because you would expect what? Only a partial entry into that blue shaded area or fair value gap. Trust me, my charter members are flipping out right now because they were never taught this. So this is institutional order flow entry drill. Or you can use the upper quadrant of this range, and that would be done like this. And you would use that price plus one tick, that 462 and 3/4 plus one tick. And that would be your entry. That would basically give you a very specific, not a zone entry, a very specific price level that would constitute an institutional order flow entry drill. Institutional order flow entry drill is a entry model where you're expecting a fair value gap to be traded into, but not fully closed in. And because you're expecting low resistance liquidity run conditions today, because of all the things I talked about in the first quarter of or first half of this lecture today, all those things building and coalescing with the idea that it's going to be a large range day, it's going to be explosive at the opening, any opening range gap should not be expected to be traded to, even though there's a 70% likelihood that half the gap should be repriced to in the first 30 minutes. Throw that to the sidelines and expect them to just really make a mad dash to get to the liquidity that we've outlined. So low resistance liquidity run entries in here, low resistance liquidity run entries here, and then this is a gap that is what? Below the upper quadrant. And this is where I would use to see if I'm on side. Now, you can take that and enter on it. There's nothing saying that you can't use that as a model. I'm not saying that I'd be comfortable doing that. I could do it, but because I have to have principles and protocols and procedures to follow, because otherwise I'm left to my flesh, and my flesh will do like it did yesterday and put me in things that I shouldn't be doing. So when I try to fancy dance and finesse my own stuff and try to, let my own experience dictate what I should do versus the process, the protocol, the model, the rules, stay on the right side of the road. Don't cross the yellow line, Michael. Well, if you're listening to me, your trading ends on the entries here or less. Anything above it, you're just using it for management purposes. So when this fair value gap forms, this is a valid fair value gap, but it should not fully close in. Why? Because we're in low resistance liquidity run conditions. We're in an early session of a potential large range day that's bullish, and we're at the quadrant, upper quadrant, and less. See that?